Well, the reconciliation bill passed through the Senate and the House, and it helps extend the 2017 Tax Cuts and Jobs Act. But there are concerns about what the bill might do to the national debt, how it will impact jobs, various other issues, and the impact it will have on the labor force. Pleasure to be joined by Kent Smetters, who's faculty director of the Penn Wharton Budget Model, as well as a professor of business economics and public policy. Penn Wharton Budget Model, by the way, has done a full review of the impacts, and Kent joins us to go over them. Kent, great to talk to you again. How are you, sir?
Be back. Thanks for having me again.
Thank you. All right, so let's dig into the numbers right now and what we see passed and signed by the president on July 4th. What are the impacts the Penn Wharton Budget Model expects to occur?
So as you pointed out, debt over time, that is higher deficits every single year over time. And so we're expecting about 3.2 trillion in additional debt over the next 10 years. And if you do this on what's called a dynamic basis, that is, you take into account economic feedback, that it actually goes up, not down. In particular, the 3.2 trillion goes up to 3.6 trillion. And the main reason there is some dynamics associated with who's paying taxes, as well as how some people can requalify for certain benefits like Medicaid and so forth. And so we show that really the impact on the economy is basically zero, or over the first 10 years, technically a slight negative by about a third of 1% of GDP. But over 30 years, a bigger negative impact of roughly about 4.5% of GDP over 30 years that this will reduce the economy by. The main drivers there are just continued increases in debt, even beyond the 10-year budget window.
You mentioned about the healthcare potential issues. A lot of conversation about that. Also, conversation about SNAP, things like SNAP benefits.
Right.
Give us a sense of what kind of impact we're going to see there.
Right. Um, so our numbers are probably not quite as pessimistic as CBO's in terms of how many people are going to lose healthcare, but they're around 11, 12 million. We're a bit less than that, but still there will be some people who will have a harder time qualifying for Medicaid. This is in large part undoing some of the expansions that happened under Biden as well as Obama on the Medicaid side. In terms of the impact on, say, by income group, so the Senate, what they purposely did is they delayed some of the hit until after the midterm election. We're basically saying the bottom 20% tile right now in the year 2027 are basically going to have very little impact, but they will still be net losers of about $165 per household. But by 2030, the bill would basically reduce resources for the bottom 40% of households. It would, if you take into account both taxes saved as well as transfers reduced, that is how much less they get, and principally in the form of Medicaid and SNAP, the bottom 40% will lose roughly about $1,000 a year. And that's mostly from the fact that some of the tax benefits that they otherwise would have enjoyed before 2030, such as no tax on tips and overtime, that pretty much wears off by that point. And the bigger loss really just comes from the loss of Medicaid and SNAP. So roughly about $1,000 per household in the lower 40% of the income distribution.
You mentioned the taxes part of the story and a lot of discussion about, the extension of the Tax Cut and Jobs Act and the
Yeah,
potential benefits. And that's talked a lot about by the administration. But
right.
there are also a lot of people out there who are saying that while there may be some benefit, it may not be as strong a benefit as what maybe people would like to see.
Sure. I mean, the administration really, I don't know how to say this more politely, but they just kind of greatly embellished the economic benefits of this particular bill. And in particular, they went as far as to say not only would the economic expansion be so big that the tax bases would grow so large that the bill would actually pay for itself. So it would grow the economy so much that the bill would actually pay for itself. It would grow so much, even more than that, that it would then bring down the debt GDP ratio, which without this bill is already increasing. And so even before this became current law, the current law a minute before this was signed, already had an exploding debt to GDP ratio over time. So they're saying this is going to create so much revenue, it will even turn that around. So it's not going to just pay for itself, but it's going to like doubly pay for itself. I mean, it was just over the top. And there's really no rational economic model that can justify that type of conclusion. So, like you said, most groups, including us, concluded that the economic impacts are pretty modest. You could go plus or negative in the first 10 years, but it's roughly around zero.
And part of the conversation also is the money, the revenues that would be coming in from tariffs, but that has a small impact on what the overall numbers would be for the government over the next several years as well. Correct?
Right. And for this particular bill, they can't count that money anyway because that money would have been attributed to what's called executive action or executive order. And so for the purpose of this bill would be excluded. It's already part of what we call the baseline. But who knows where that money is going to come down to? I mean, if we took the April 2nd, rates seriously, and that's almost created a meltdown of financial markets. That would have raised potentially $4 to $5 trillion over 10 years, but at the same time really crushed the economy. But if we look at more modest rates of that they're potentially looking at, or maybe talking about a couple of $1 trillion over 10 years. But the problem with that is that even if you use all that money to try to pay down debt, that is to reduce the budgetary impact of this bill, you're also really playing with capital markets. You're narrowing the base of capital markets over time by which you are trying to sell all this debt into. And so, on one hand, you get some revenue so that you can use it to reduce debt. But we really need a really open market, worldwide capital market to be demanding our debt. And to the extent that a reduction in trade reduces but the demand for our debt, that's going to be much more negative than any positive income that comes from the tariff revenue.
And longer term, as you said, there's an impact to the downside over the next several decades with this bill in place, and that would obviously mean there's a negative impact on GDP as well.
Right. So even putting the tariffs issues aside, we're projecting that indeed this bill would, now law, it would reduce GDP by over 4.5% in about 30 years. So it really does add a fair amount to debt because it's not only that it's bigger than the House version that was, previously passed on the House side. What the Senate really did is they said, we're going to make a lot of these provisions permanent, for what's called bird rule compliance. Will pretend like anything that's already in the Tax Cuts and Jobs Act will not cost us anything because and so there's a little bit of a counting game going on. But in terms of actual debt that has to be sold by the U.S. Treasury, that's going to remain the same. And it's just more things that we have to finance really using debt. So there are options out there to deal with this, growing debt problem. It's just that they're not being
We're not
discussed right
there.
now in DC.
Yep.
Yeah.
Yep. All right, Kent, great to talk to you. Thanks very much for your time, sir.
Pleasure.
Thank you. Kent Smetters, Faculty Director of the Penn Wharton Budget Model and Professor of Business Economics and Public Policy at the Wharton School.